What's up, duly diligent investors? Today, we're going to be talking about yet another high-yield covered call ETF. It's the Roundhill Covered Call S&P 500 0DTE ETF, ticker symbol XDTE. This is an impressive high-yielding ETF that touts nearly a 27% annual yield in dividends while capturing some of the market gains of its underlying for the S&P 500. Is it legit? Is it sustainable? What are the risks? Is it worth investing in? Let's dive in and find out in this quick crash course so you can feel confident about diving in or steering clear of a yield trap. Oh, and did you know it pays weekly? Yes. Just like working in Silicon Valley, you can grab weekly paychecks with this high-yield dividend ETF. Let's get into it. What is XDTE? XDTE is a dividend-focused ETF, as you probably already know. This ETF uses a synthetic covered call strategy to provide current income on a weekly basis while also offering exposure to the price return of the S&P index, or SPX. The term 0DTE or ODTE refers to 0 days to expiration, meaning that the ETF sells out of the money calls that expire on the same day. These are also known as 0DTEs, which have blown up recently in popularity, especially among retail traders. Hey, why did the 0DTE option go to therapy? Because it had 0 days to expire and it was feeling a bit worthless. Similar to other covered call ETFs like TSLY, Coney, YMAX, QYield, XYield. Yeah, this fund employs the same strategy of using call options that are out of the money. The only difference is that they use 0 days only. This is why they can generate income so quick compared to other covered call ETFs. Since they're making money daily, they can afford to keep paying it out every week on Friday. How's that for making money while you sleep? So how does XDTE generate this income? XDTE aims to generate income by selling these options daily and having them expire worthless. That's the ideal case. By market close. 0DTEs are very dangerous inherently because of gamma exposure. But if you have a verifiable edge, you can definitely generate a positive P&L expectancy. There are already multiple proven strats out there that have tons of research behind them for trading the 0 day, such as the MEIC or BEIC. It's an actively managed ETF designed to harness market volatility and exploit any structural market mispricings. They have a detailed strategy laid out on their prospectus if you want to get into the nitty-gritty and do this yourself. But for most people, letting them handle it and paying the expense fee is good enough. I mean, divvies are supposed to be passive income, right? It generates income using synthetic covered calls. It basically sells 0 day calls on SPX each morning. They also buy in-the-money flex options to get synthetic long exposure. If you heard of a poor man's covered call or diagonal, this strat is similar in concept. The captured premium is distributed weekly. Let's take a look at the dividend history. XDT pays dividends weekly, which is pretty awesome if you love regular income. It's not the first ETF to pay weekly. I mean, there's weekly. Over the past year, it's paid out a total of $10.73 per share in dividends. In weekly numbers, that's about 2 to 64 cents per share per week. It's pretty volatile and it heavily depends on market conditions. It fluctuates, but so far, since inception, XDT has not missed a single dividend payout. It's paid 51 consecutive dividends so far. The dividend will be less if the market is rallying since their ODT positions will be breached, which will force them to roll or cover their position. To put it into perspective, that's crazy yield. The market has been on a massive bull run as of late, so we can't say how long this dividend yield will last. But putting out a yield of 27% compared to traditional investments like yielding 10% by putting all your money into SPY or even yielding 12% by putting all your money into real estate, getting a whopping yield of 27% is pretty crazy. Let's talk about performance. XDT has a current price of around $50 at the time of this video. Since inception on March 7, 2024, it's returned a total of 17.79%. That's not too shabby. XDT's performance over the past year is slightly negative, down about 3.85. However, the dividend yield more than made up for the NAV erosion with a whopping 27% yield. So even with the 3.85% loss, we still made about 18% overall. That's pretty good. Given that this ETF deals with 0DTEs, it's pretty impressive that it actually beat the SPY over the past year. The dividend has remained pretty stable and reliable, plus minimal drawdowns, which is pretty surprising given the nature of the synthetic call strategy. Let's talk about DRIP versus no DRIP. Some people really like to talk about this topic. DRIP stands for Dividend Reinvestment Plan, where you basically reinvest your dividends back into the company to buy more shares. It's like letting your money make more money for you. However, some people don't like to enable this because they want to use the dividends as beer money, or they don't want to put it back to reduce risk. Others like to buy the dip, so they wait until they see a good opportunity. Regardless, here's some stats. If you had DRIP disabled, meaning you cashed out every Friday and used your funny money on 7 topping dominoes with wings and even some extra sauce, your principal would actually be very stable. As you can see, an initial investment of $10K on inception day would have lost you just a few dollars per share. So because of the high yield, you'd be overall on top. You could cash out now by selling your shares if you wanted to and collect all those dividends, plus cash out your minimal loss principal. So basically those dividends would have been free money, right? On the other hand, if you had DRIP enabled, you'd be up to about $11,644 because you bought more shares each time the snowball effect was activated. This means you bought more shares by reinvesting your dividends each Friday to make more sweet dividends. Because you have so many more shares, you'd be getting a bigger paycheck each time. So you come out with even more green than if you had DRIP disabled. By reinvesting your dividends, you can compound your growth much quicker. Your account will explode exponentially compared to if you constantly withdraw. Overall, you would have made more money if you just kept drip enabled. You would have more shares with a higher overall dividend return compared to pulling it out every time. This is how the wealthy build more wealth. Now let's talk about a real problem with XDTE, NAV erosion. NAV erosion is something you have to watch out for. NAV basically represents the per share value of the fund's assets minus its liabilities. NAV stands for net asset value, which is basically the stock price. This is extremely common with these high yield ETFs since they cap their upside. The markets have been bigly up for the past few years, so calls constantly getting breached forces them to buy it to close for a loss or roll it. High yield covered call ETFs will never capture the full amount of the underlying. Capital appreciation is second to income generation. But you knew that already, right? Or else you stick with something like SPY or SCHD. Most covered call ETFs are negative in NAV return. XDTE is still too new to know if it's going to suffer the same issues as other ETFs, but the dividend yield usually makes up for the NAV erosion in most cases. For XDTE, the NAV has eroded about 3%. If you can find a CC ETF with a decent yield that has a rising NAV over time, tell me. So what markets does XDTE excel in? XDTE has ideal performance in slowly rising bull markets. This is because of the zero DTEs. If the market constantly climbs, they'll get breached, which results in them having to buy to close or roll the positions. Wild swings or a high VIX environment will increase option premiums, but also make it more susceptible to getting these strikes breached. It's a double-edged sword. In rising markets, the NAV should rise, but the premiums will be smaller, which means your dividend payout will be less per week. XDTE may also perform well in neutral or slightly bearish markets for the same reason. You don't want wild swings in this fund. In slightly bear markets, the zero-day calls will net more premium with lower deltas. However, the underlying SPX will also decline. While the premiums are juicier, the NAV declines, so your principal while your yield increases. This is why you get bigger payouts, especially with the elevated VIX in bear markets. In very bear markets, the NAV will just tank just like the underlying. So who should invest in XDTE? XDTE is for income-focused investors who want regular payouts and can handle some market volatility. If you love weekly income and have a moderate risk tolerance, XDTE might be your jam. If you love high yield, that's the main reason why people invest in this. With its 27% yield at the time of this video, that is an exemplary return compared to other traditional investments. Of course, high yield means high risk. If you have a moderate risk tolerance, because zero DTEs are inherently dangerous already, that's why you're compensated with such a high yield. If you want some S&P 500 exposure, XDTE holds the biggest 500 companies in the US. XDTE does capture some of the upside of the market, but it's never one-to-one. Because it's a covered call ETF, there will be some limited upside. If you want active management that constantly adjusts their positions in order to capture the premiums, XDTE will do that for you. With the high expense fee, that's the price you pay for the labor. I really like this fund, and I am considering picking up a few shares at the next PTFT opportunity. I might grab a few shares and just have some fun with it. Also, I want to thank the two people that commented in the last video. BreakLate879, thank you for your positive comment, and Narsutis on how to split up SPY and QQQI for tax benefits. Thank you both. If you like this stupid video, go ahead and hit the bell, comment, like, subscribe, and all those other things so you don't miss out on the next big dividend. Until next time, keep doing your DD, keep investing, and keep getting paid. DGen out.